Lending money online is a great way to earn passive income. Unfortunately, many investors who use various P2P lending platforms think that all investment apps are the same. Understanding the differences between various P2P platforms is essential as it influences your investment's return, risk, liquidity, and the experience of how easy or difficult is it to use a platform. And that's precisely what I will be covering today. So if you're a beginner or someone who is thinking about investing a significant amount of money into P2P loans and earning thousands of euros every year, this video is for you. I'm your host Jakub from P2P Empire, and if you're interested in becoming more educated about earning passive income by investing in loans, consider subscribing and hit the notification bell to avoid missing out on future videos. So let's first give you a brief introduction to how peer-to-peer lending works. P2P lending is essentially a process that connects investors with borrowers via P2P lending platforms. Investors invest money through a platform that lends it to borrowers. Borrowers repay the money with interest, the platform takes a cut, and you, the investor, get the rest. Realistically, you can earn a stable return of around 10% per year. For most investors, that's a pretty good yield. The problem is, however, that there are hundreds of P2P lending platforms out there promoting safe investments and high yields. If you're just starting out, you might have a hard time differentiating between various platforms, which is exactly where P2P Empire comes in to help you make a more educated investment decision. Our website p2pempire.com is one of the very few independent sources that teach you how to choose the right platform, what to expect, and how to make a decent return. We spend thousands of euros every month researching the industry, talking to experts, visiting platforms, and producing high-quality content that you can access for free. Despite having a lot of information at your disposal, it can be quite confusing to navigate through it and figure out the core differences between various platforms. If you are planning to eventually invest thousands of euros, you should have a good understanding of the differences between various platforms, as this type of information can make the difference whether you make a return on your investment or whether you lose it. While most investors are comparing the return and the protection type, which is something you can do on P2P Empire within just a few seconds, it's a good practice to dive deeper into various platform types. Alright, so peer-to-peer lending platforms can be categorized into 4 types. Simple P2P lending platforms, P2P lending marketplaces, crowdfunding or crowdlending platforms, and crypto lending or earning platforms. So P2P lending platforms are companies that take 2 roles simultaneously. They offer a platform where investors can invest the money and allow borrowers to borrow money. They are a non-banking lender, raising funds from retail investors to fund its loan book, which is basically its portfolio of loans. The lender can be a company issuing loans in one country or part of a bigger group with subsidiaries in various markets. Here you can see a few companies following this type of business model. It's important to understand that those companies are being paid by the interest they charge to the borrowers, which is the main income stream. Those companies are typically following local regulations. They often have a lending license to issue loans in dedicated markets in Europe. Some markets also regulate the investment part of the business through an investment firm license, as in Latvia. In most cases, investors fund short-term or consumer loans that are unsecured but backed by a 60-day buyback guarantee, which is essentially a promise that the lender will repurchase your investment should the borrower be delayed with its payments. Investors are typically receiving interest and loan repayments every month. The liquidity depends on the platform's features. Most offer a secondary market so that you can exit your position within just a few days. So what are the pros and cons to consider when investing on P2P lending platforms? The benefit is that you are investing in loans issued by a lender that is likely regulated. That's at least the case in many European markets. Additionally, the company has direct control over risk management, meaning they know exactly how the portfolio performs at any given time. The disadvantage of peer-to-peer lending platforms is that market diversification is somewhat limited. Additionally, investors might suffer from cash drag if the supply of loans is lower than the demand from investors. In most cases, a real P2P lending platform is more focused on the lending part rather than the investors, which means that there isn't much development on the investor side. It's not always the case, but some P2P lending platforms are pretty underdeveloped, meaning they lack features or look like they were built 10 years ago. Now let's talk about P2P Lending Marketplaces. A P2P Lending Marketplace is basically a middleman between you and the lending company. If the lending company does not want to build its own platform to attract funding, they often reach out to those intermediaries that list loans from various lenders. Those marketplaces are being paid by a percentage of the amount of funds they can deliver to the lender. So the client paying the bills is the lending company, not the investor. Investors who invest on P2P lending marketplaces have a large variety of loans available. In most cases, the loan principal and interest are repaid every month, so you can expect regular monthly cash flow. It's important to note that only a few actual P2P lending marketplaces are currently regulated in Latvia. All the other P2P lending marketplaces are not regulated in their respective countries where the companies are registered, as there is no pan-European regulation that would apply to this type of business model for intermediaries. In terms of protection, similar to real P2P lending platforms, your investment is protected by a buyback guarantee. If a larger group owns the lender, you might also benefit from a group guarantee, which is another level of protection, should the lending company be not able to cover the obligation towards investors. This is quite useful, especially in force majeure events like the war in Ukraine, where the other lending companies within a group cover the obligation of war-affected lenders. The liquidity on P2P lending marketplaces might be slightly higher than on P2P lending platforms. It always depends on the features that a marketplace is offering, as well as on the long term. So the pros of P2P lending marketplaces are that the company acts as an additional filter for investors. Some marketplaces have their own risk scoring models for lenders with various limits. While in theory this should increase the protection for investors, I would argue that this really comes down to the management of the marketplace and its risk appetite. Remember that the lenders are paying the bills, so there is clearly a conflict of interest. A benefit of a P2P lending marketplace is that typically there is a higher availability of loans, meaning that the chances are higher that your money will always be invested. Additionally, the diversification of your portfolio is typically better on a P2P lending marketplace. The downside of a P2P lending marketplace is that the lending company is paying the bills, so the goal will be to fund as many loans as possible. This might lead to eventually suspended lenders and locked funds for investors. Investors should do their own research about individual lenders before investing on a marketplace. I would argue that researching various lenders in emerging markets will be a better protection than just blindly diversifying your portfolio across all lenders, which is the advertised strategy on many marketplaces. Here are a few platforms that can be classified as marketplaces. Some of the marketplaces are partly owned by lenders sourcing funds from the platform. Now let's talk about crowdfunding and crowdlending platforms. Crowdfunding and crowdlending platforms have similar business setup as real P2P lending sites. There is no middleman, as the platform is raising money and lending it to borrowers. One of the most significant differences between P2P lending platforms and crowdlending platforms is that crowdlending platforms are typically funding business loans and not consumer loans. The loan repayment frequency may also vary. Most of the more prominent crowdlending platforms are funding bullet or full bullet loans, meaning the loan principal will be repaid at the end of the loan term, so the risk of default is not decreasing during the loan period. This is not the case with consumer loans, where the loan principal and interest are repaid in equal installments. When investing on crowdlending platforms, you usually get the loan back at the end of the loan term. Sometimes the platform pays monthly interest, but this is something you need to look up in the loan description. Local authorities often regulate the business model of crowdfunding platforms. The European Union has also recently introduced regulations for European crowdfunding service providers, which will level the regulatory field for operators in Europe and increase the protection of investors. From a legal standpoint, regulated crowdfunding platforms are likely the most legitimate businesses in the P2P lending space. Most crowdlending platforms offer business loans often backed by tangible collateral such as property, crops, heavy machinery, or other types of collateral. Evaluating the collateral's value is certainly a topic for more experienced investors. However, it brings more transparency into the risk assessment of investments in the crowdfunding space. Often, your investment is backed by a mortgage, which is more valuable than a buyback guarantee by a lending company operating in an emerging market. While many crowdlending platforms offer a secondary market, the liquidity might not be as high as on some of the other platforms. The benefits of crowdlending platforms are increased transparency, a more developed regulatory environment for regulated players, and potentially higher protection as your investment is backed by tangible collateral. Certainly, even in this category, some platforms are not regulated, nor do they act in the best interest of investors. It's recommended to conduct your own research to ensure that the platform is legit and not a scam. We have seen many crowdlending platforms in recent years that stole millions from investors, damaging the reputation of crowdlending sites in Europe. The downside of this business model is that any debt recovery takes longer due to the nature of the loan type. The loans often come with a loan term of 12 or more months. The default risk of this investment can change during this period, and the recovery of such loan can take some time. which harms your liquidity. Here are a few platforms that can be classified as crowdlending platforms. Now let's finish up this video with the last category, which are crypto lending and earning platforms. Cryptocurrencies are already a somewhat speculative asset class, so it naturally attracts different type of people. The premise of crypto lending platforms is to take your crypto deposits and pay interest in exchange. Crypto lenders are basically unregulated hedge funds. While some of them have a virtual currency service provider license enabling companies to store and exchange crypto, there is no regulation for yield-generating activities, which are often undisclosed to users. Many investors are not aware of how those crypto lending or earning platforms generate those yields. This means that you might as well fund a Ponzi scheme, or worse, follow the business model of Celsius network and gamble with users' deposits. While some of the yield-generating activities are connected to funding over-collateralized loans, many platforms follow various high-risk trading strategies. While many platforms pay out interest daily or weekly, the risk that a company will freeze your account is much higher in this space. You can only evaluate the risk if you understand the various yield-generating strategies, which most users don't. In terms of liquidity, crypto lending and earning platforms offer the most liquid investments. You can either withdraw your crypto to another crypto wallet within a few minutes, or exchange it into fiat and request a withdrawal to your bank account, which takes up to 2 business days. If you have opted into some of the offered staking products, you must wait to access your funds until the lockup period is over. The pros of crypto lending and earning platforms are liquidity and usability. Most platforms are paying yield on your deposits, so you don't need to do anything after you top up your account. There are many downsides to crypto lending platforms, mainly because some are run by dishonest people, borderline criminals who gamble with users' funds. This industry has not matured yet, meaning there will be more platforms going bust in the future or simply winding down. Crypto lending is not regulated, so there is no investor protection in place. Additionally, some platforms offer yield on crypto just as a side product. Many developed advanced high-risk leverage trading features that lure investors with attractive potential yields. Those types of products can lead to the total loss of users' deposits. Some platforms also charge fees for the exchange and withdrawal of funds, so the return might be much lower than you expect, especially if you have deposited just a small amount. If you don't research crypto lending platforms, the chances of losing all your funds are exponentially higher than earning any yield. Here are some of the platforms still operating in this category. Now, you might wonder which platform types are the safest. I will talk about the risk assessment in one of the future videos, as it goes beyond the scope of this clip, mainly due to its complexity. But in short, the safety of your investment on any platform depends on the risk appetite of the decision makers, which are the platform's owners, CEOs or risk managers. It's essential to research their past and check their track record. If you find a lot of inconsistent information and no experience in the banking and lending industry, it's a sign to stay away from the platform. Frequent management changes can also be a negative sign to pay attention to. There are 2 ways to build trust in this industry. One is the easy way, to use paid ads to promote your brand. This can be done through big media sites, influencers, forums and review sites like Trustpilot. Sponsorships, giveaways and AMAs on YouTube are also quite popular in this space. Those are all compelling tools to control the narrative and build a presence quickly without giving insight into the platform's risk management. The second way to build trust is to offer a great product, be transparent about the business model, provide insights into financials, and protect investors' interest over a more extended period. I suggest you look for platforms that follow the second path. While any type of investment comes with risks, you can mitigate them by doing your research and monitoring your portfolio. If you have found this video valuable, hit the like button. For more information about the best P2P lending platforms, head over to P2P Emperor and read our independent reviews. Before we go, let me know in the comments below which platform type you prefer the most and why. Thanks for watching, and I'll catch you in the next one.